Let's talk a little bit about Starbucks. Starbucks is an interesting company, a great company for the last 10 years or so. In fact, I think I said I should have. I'm going to look at their chart for 10 years to see what I've missed out on because I didn't invest in them, some time ago when I taught a personal finance class and we talked about it. So its price back then, and probably split adjusted. I don't know if it's split or not, maybe, but it was $17.83, and it now sells for $56.90. So in a period of 10 years, it would have tripled in value. Yeah, that wouldn't be too bad. Wouldn't be too bad. It does pay a little dividend on top of that. So 10 years could have tripled. Yeah, bummer. Yeah, no use crying over spilt milk. But anyhow, Starbucks. So I looked at the graph. That's kind of cool. But again, that has to do with stock price, which I'm not terribly interested in. Price earnings, price book, price sales. So it's an expensive company if you look at that, according to that. But then when you see all these other green things, what that tells you is it's an expensive company for a reason, because it has revenue growth that far exceeds the industry average, and it has net income growth that really, really exceeds the average, and operating margins that are better, net margins that are better, ROA and ROE that are much, much better, right? And hardly any debt. Okay, debt to equity means so its debt is half of what its equity is. Remember, if you listen to the Pepsi one, Pepsi was very much the opposite. A lot of debt. Pepsi was what I would call a fairly highly leveraged company for a big company. Okay, and in this case, you've got Starbucks, which is not highly leveraged at all, rated an A. Isn't that interesting? That Pepsi's actually rated better than Starbucks. So. Here's what we look at, and there's a couple things even here that kind of jumped out at me that whoever's doing Starbucks maybe need to talk about. First, you got great revenue growth, right, from 15 billion up to 19 billion in 3 short years. That's pretty good. But you look at this. Wait a minute. 2013, we had negative operating income. Something happened. Okay, they had to take an extraordinary charge to income. They had to restate earnings. They had to do something, right? And their net income was only 8 million versus 2.8 billion that they had here in 2015. So something went awry there. Okay, and what that was, I don't know. Obviously, it had to do with restatements. So that's something you need to take a look at, right? And whoever's doing Starbucks, you got to tell me what happened in 2013. Okay, total assets are growing, kind of about commensurate with looks like with their revenue growth and whatnot, and liabilities on the other hand coming down. So a little bit the opposite of Pepsi, although it bumped up, went down big in 2014 and then bumped back up this year. But shareholders' equity, just a nice, good, steady increase. Okay. And then again, we come down here and we get a little bit of a weird thing. So cash flow from operations, and 2013, some weird things happened here, but then all of a sudden in 2014, you get this weird cash flow from operations really took a dump, and why I don't know, and so that's where worth taking a look at and trying to figure out what happened there in 2014. So you got this nice steadily growing company. In fact, when I looked at it, I thought, oh, this one's going to be boring because probably nothing exciting's happened with the company, and it's just been growing like crazy, and it has. Okay, but obviously there's been a few little hiccups, not in the growth or profit or any of those things, but there's been some hiccups in the financial that are just a little bit different. So income statement, look at that growth, almost double in 5 years. Wow. Okay, that's impressive. And at the same time, operating expenses have not come even close to doubling, so we should be seeing some really great improvement in margins. It looks like their gross profit even has benefited a little bit. Let's just take a look at those real quick to see if I'm right about that. So, yeah, gross profits improved a little bit. And total operating expenses, what a nice, see, they had a weird thing in 2013. Remember, that was the year then that they didn't have operating cash flow, so they had this huge other operating expense. So it looks like in 2013 they also had something weird going on that required, maybe that was the year, right? It was 2014 14 that they had the weird cash flow. Maybe those were both 13. Yeah, I might have to go back and look at that now. Okay, so this was the weird year, but if you look at the trend, on the other hand, you went from about 45% operating expenses down to 40, and at the same time you've increased gross profit margins by 2%, and you've improved this by 5% nearly, or 4%. So that's a 6% improvement, and you see that from 13 to almost 19. That's huge. You know, you're talking about 19 billion in sales, right? And you just improved that by 6%, or what's that? Yeah, gosh, I can't even think of my math, but is that 1.2 billion extra in income, in gross operating income? You know, look at that. But on growing sales, you know, so that'd be 1.2 billion on the old sales. It'd be more than that when you also consider that it's improved sales dramatically. So, what a nice, you know, nice looking income statement there. See if there's some other things. Again, there's something weird that happened here in 2013 that really had an effect on operating income, and we'll take a look at that cash flow too. So earnings per share. You know, look at that, nice. Look, and so we're probably going to see, their shares outstanding have stayed about the same, so they're not buying back stock. But look at that, their earnings per share have, well, of course, their income. Their income has more than doubled. Operating income has more than doubled. Their net income has more than doubled, and so yes, their earnings per share, without buying any stock, have more than doubled. Again, you got that little glitch there, but other than that, it's just been boom. You know, 83 to 92. You know, who knows what this would have been, and then a big bounce up and another huge bounce up here. You know, $1.84 there. So, just outstanding growth that you're seeing with that company. Okay, now this is 2013 that we saw the operating income thing go awry. I want to take a look at the cash flow. In 2013 and see if that's where the weird one was. And it looks like it had something to do with deferred income taxes. Okay, and so that created, you know, this huge, well, that would have been a plus, a positive, because net cash provided by operations actually was a huge increase. But then they used quite a bit for investment. Yeah, so in 2013, when we had the weird operating income thing going on, which might have had something to do with this, that's strange. And then it was 2014, though, when we saw the huge decrease in the operating and the free cash flow. And what would have caused that in 2014? Accrued liabilities. And I wouldn't doubt that these are maybe related. I don't know. Sometimes those have to do with purchases and whatnot, and they have to write off some balances, mergers and acquisitions when I say purchases. So you got a couple weird things going on there, okay, that have obviously an impact on their operating cash flow. And this, again, much like their earnings, you know, was a nice steady, but we had some weird things. This one obviously affected, or I'm not sure that this is what affected income. It could be the opposite because it provided cash, but something affected its income that I'm not seeing here. Okay, and then we see accrued liabilities just huge here in 2014. So got to go figure that out. I got to go back and look at that income statement for 2013 and see. Again, we saw a big increase right here in other operating expenses. You know, that's 2.7 million, 2.7 million dollar increase in other operating expenses. You know, totally inconsistent with anything that goes along there, and so, you know, that needs to show up. Okay, we need to know why. Yeah, everything else nice and steady. So figure out what those aberrations are for Starbucks. Those are things to report on. And then naturally, when you make your recommendation, though, you're going to concentrate too on the final year or two and what they've been doing in terms of growth, what they've been doing in terms of earnings per share, its balance sheet. You know, we didn't spend a lot of time on its balance sheet, but we saw that its debt to equity was really low compared to the industry and low compared to a lot of them. So here's a company that doesn't have a ton of liabilities. You know, even though it's growing like crazy, total liabilities have gone from $3 billion to, just in this last little bit, that's the trailing 12 months or through September. So their year end is September, so that is their last year. So their liabilities have doubled, but at the same time, total assets have also increased pretty dramatically. So it's a looks like a well-run company, safe, all those other things, and so you need to concentrate on those things when you make your recommendation. That's it for Starbucks. Good luck, and I'll look forward to getting everybody's reports here into this week. Thanks.